Rates have been raised 12 times in the past 15 months, though they were on hold this week. The objective of all that? To quell inflation. The problem is it doesn't seem to be working here and around the world. The US, which is seen to be 6 months ahead of Australia's economy, is set to raise rates another 2 times at least. We might get the same thing. Well, this week I spoke with Westpac's Bill Evans to assess the conditions and whether all this means rates will have to stay higher for longer.
Yeah, Ross, look, I was overseas for about 3.5 weeks, and I was at the east coast of the US, Europe and London. And the themes that came back from me are very much these legacies of COVID, such as a much higher proportion in those countries, apart from the US, that have fixed rate loans. Interest rates were very low pre-COVID. People even longer fixed rate loans than the 2 or 3 years that we have, locked in at very low rates. So what you've seen around the world is that the impact on household cash flow that you normally expect from higher interest rates has been muted by the much higher proportion of fixed rate loans in this cycle than we've seen in the past because of the very, very low rates associated both pre-COVID and post-COVID. The second imbalance has been this imbalance between the demand and supply of labour. Demand really boosted by reopening, fiscal stimulus, and supply being affected by border closures and early retirements. So you've seen that imbalance in the labour market lasting longer than you would normally expect. And of course, the third one is the build-up in savings, particularly the higher income people who are now putting those savings to work in assets. So that big transmission mechanism that, say, in particular the US relies upon through the equity market has been muted by the fact that this extra liquidity has been propping up the US equity market. And then in other economies such as Australia, Canada and the US, you've seen the housing markets respond a lot more quickly than you would normally have expected given the higher rates as people have moved their savings back into housing. So these legacies from the post-COVID period are absolutely making it harder for central banks to get that traction, particularly around the services inflation and the wages. That means they do go for longer, and the risk is that they run into a non-linear event where things slow very rapidly under the weight of excess tightening.
I was going to ask you about that because is that the danger now, that something, a black swan event, whatever it might be, happens and really the world is not well prepared for that to occur? So, the risks are now heightened simply because the central banks can't bring this inflation quickly under control.
I agree with that. But I think what will eventually happen is that as they remain high for longer, they will have a very sudden impact upon their economies. So we'll see the slowdown happen more quickly than we're currently expecting. And that, of course, will mean that we'll have to see a very reversal in monetary policy around the world. So I would expect that by the middle of next year, in the case of Australia, maybe a bit earlier in the US, we'll see the conditions evolve for interest rate cuts. But in the meantime, people will get quite frustrated. Think about the US. 3 months ago, the market was expecting rate cuts in the US in July, August. Now, of course, they're expecting further hikes. So they've been delayed. They're going to remain higher for longer, but eventually you'll see that non-linear event where things do slow more quickly, possibly accelerated by a black swan event, as you say. I don't even think you need a black swan event. I think that the build-up of this tightening will eventually weigh through as those buffers from the post-COVID period start to ease, particularly, say, accumulated savings for low-income earners, etc.
So tell me, what sort of position are governments in around the world having a build-up of debt post-COVID to actually cope with any economic slowdown or an economic shock? We've got a government here that's very firmly in surplus at the moment, but with significant amounts of debts building up as you go into the out years of the budget.
Yeah, look, I think governments are obviously dealing with higher debt, and our country is in that situation as well, apart from the short-term reprieve we're getting at the moment. But my view is that from the perspective of the cost of borrowing going forward, the big issue will be when these economies do slow down, when inflation does start to come back into line with targets and central banks are cutting rates, then the cost of borrowing for governments will come down as well. So in terms of where we see the investment opportunities at the moment, certainly the bond markets, bond interest rates are looking incredibly high at the moment. And if I'm right in terms of that profile, then bond rates should be coming down next year.
So that being also the case, just tell me, does the Reserve Bank still need to keep its foot on the pedal for interest rates? Is there a couple more, or really is it now we can start to see the peak in sight?
Oh, look, we're expecting the peak will be in September. We think there'll be 2 more hikes. We think that the tightness of the labour markets and the risk of a spillover from wage inflation to higher from wages to higher inflation, and that concern that central banks have around the world of some sort of a return to the 70s, I think that'll keep them on very vigilant. So I think that we will see further hikes here. But by the time we get to September, the strength of the Australian economy will be really under pressure. The Reserve Bank will realise that they don't need to go any further. We're only expecting growth in the Australian economy this year at 0.6%, and with 1.8% population growth, that's minus 1.2% in GDP per capita. That's a very big slowdown. Same next year. So there will be a point when central banks will realise that enough work has been done, but I don't think we're there yet in Australia or elsewhere.
It's interesting to note that as well, because that's the big issue about those extra interest rate rises. Just one other thing about this also is the Reserve Bank itself. The Treasurer says that he will make the decision as to who will be the next Reserve Bank governor, or maybe the current one, after September when the term expires. Is the job of whoever that person is going to be any different from the job that Philip Lowe has confronted over these past few years?
Ross, I think the job is going to be a lot more difficult if the recommendations from the review go through. And the reason I say that is that the recommendation from the review is that we continue to have 9 board members on the Monetary Policy Committee, 2 of whom are internal from the Reserve Bank, 7 of whom are external. That and these 7 directors, unlike the ones we've seen in the past, are going to be chosen on the basis of their responsibility to challenge the Reserve Bank and on the basis of their monetary policy expertise. We've seen models like that overseas. For instance, in the Bank of England has 5 internals, 4 externals. Canada has 5 internals, 1 external. New Zealand 4 internals, 3 externals. So in other vicinities, the internals have the majority over the externals. Whereas in the case of Australia, as the review stands today, it'll be the reverse. That'll make it a lot more difficult for the Reserve Bank governor to be able to stamp his authority, because after all, he is the one that has to achieve the inflation target.
So tell me this, is it a job you'd be keen on? It would be the sort of job that would be an easy one to navigate, do you imagine?
No, I think it'll be a difficult job because you no longer have the majority around that table of internal reserve bankers. And so given that each decision will be taken to a vote, you're going to have to convince 7 of the outsiders to your view. That is going to be a tough challenge for the governor, for the governor going forward.
Bill Evans, you remain the Chief Economist at Westpac. Many thanks for your time today.
Thanks, Ross.